Corporate finance practice problem using OneNote. Net present value NPV delayed payments. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side in the practice problems, then down in the 1226 net present value NPV delayed payments tab. Also note, when using OneNote, look at the immersive reader tool. Our presentation's up top, mirror down here in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing out the icon, we have our information up top. We're going to go through the calculations on down below. We have a similar scenario as we have seen in prior presentations, but with the difference of the cash flows that we expect to be receiving in the future are starting a longer point out into the future. So we have a delayed period before we start receiving the cash flows. So we have a situation with the initial investment. You might think about this situation as an investment in equipment, some kind of investment, some kind of project that's being invested in, inventory that you're putting down money, in this case the $200,000. The cost of capital is going to be the 9%. That's you might hear this called the required rate of return, the cost of capital, the discount rate that we're going to be using within the problem. And then the future cash flows, or the reason that we're thinking about putting down the $200,000 would be not starting until 5 years from the date that we put the money in. Then we're going to have 40,000, 50,000, 60,000 going up 65, 70, and 75 up through 10 years out after we put down the initial investment. So now we want to present value this. We're going to use the time value of money calculation to analyze this being the net present value calculation. Does it throw us off that it's a delayed payment that's not starting until 5 years after we put down the initial investment? And you might think about this as something like putting down the $200,000 and you're building up or setting up the project, and you're not going to get the return on it until a period after, the initial investment here. So does that throw off our analysis? It shouldn't. We can't really use the annuity type of calculation with it, but we could set up our present value of one calculations in a similar fashion. This would be something that would be far easier to do in an Excel type of worksheet, because we can then set up our table. As long as the table's set up properly, we can go through it. So we do have this in Excel if you want to take a look at that as well. So scrolling down, this is how we might set up our table to analyze it. Note that in a situation like this, you could set up the table in a few different ways. In other words, you could set up the table to show all the periods that would be including the periods with zero repayment. Or, as we'll see down below, you could set up a table that simply shows the periods that have activity in it, which of course would not include all these zero periods. So we'll see both of those methods. It might be easier to use one or the other method when you're setting up the table, and then you might decide on a different method for presentation purposes, say in a if you're presenting your information, for example. So we have our periods 0 to 10. I'm just going to put all the information here. We'll put it in our data. Period 0, I'm going to have the outflows as negative. So the outflow is negative. That's going to be the original $200,000 that's going out. Then we have period 1 at 0, period 2 at 0, period 3 at 0, period 4 at 0, and finally, period 5, 40, 6, 50, 7, 60, 8, 65, 9, 70, and 75 in period 10. If we add up all that information, then not taking into consideration time value of money, we get to the $160,000 total, basically gross profit at the end of the day. But we want to take into consideration time value of money. Remember that as we do so, we will be using this discount rate here, or this cost of capital, which typically would include what we would be requiring as our rate of return. Therefore, anything that's a positive number here when we do this calculation, we would think about accepting, because it includes the return that we are including. So when we do the present value, in other words, it can be a little bit deceiving, because we get to the bottom line and you might think, given that term, that it means that's just taking into consideration the time value of money in terms of interest or inflation, right? But it's not simply inflation. It's not just recording the deflation or devaluation of the dollar, but it is including our cost of capital, our return in it. So anything that is positive could be good. Now note that although we have 160,000 down here, obviously there's going to be a heavy impact given the fact that our inflows do not start until a later time period. So we would expect then we have to have much bigger, basically, returns in terms of dollar amount for this to be an acceptable project, given the fact that the inflows don't start until far out into the future. So if we did this type of present value calculation, I'm going to do it on the first one here. In practice, if I was putting this into Excel, this is the way I would want to do it so that I could then copy it down, even though you could just say this first one is obviously 200,000. The rest of these three are zero because they're zero. But if you're going to have this table here, it's useful to use the present value and have the whole column using the same kind of calculation. That way, it's uniform. You can see what's going on. And if you changed your data up top, it would automatically populate then down below in the table. So this first one, if we did our present value calculation at time 0, present value would be the rate. The rate would be, of course, our 9% up top, cost of capital. I would make that an absolute reference if it was in Excel so we could copy it down, comma, number of periods is going to be 0, and then comma, comma, because it's not an annuity, the future value then being the 200,000. So then I would copy that down to these cells as well and do the same calculation, even though, again, they're all 0. So you could just say this equals the same number. But from a logistics standpoint in Excel, I would put the same formula. Same formula down here. It would be negative present value. The rate would once again be that 9%. Then we have comma, number of periods. This is 5 periods out now that we're going to bring back to period 0, discounting at that percent. Comma, comma, future value is the 40,000. That then is 25,997. Notice it brings it back. It's a much lower number given the fact that we're starting our finally repayments 5 years out. We would do the same process all the way down here. And then if we sum up these series of payments, we get actually to a negative number of the 14,835. So that means that we didn't clear the cost of capital. We didn't clear the hurdle rate. We didn't clear the cost of capital of the 9%. That would be the case even if this was basically a -1, right? That would mean that we didn't clear it. But if it was 1 or 0 or above, then it would mean that we did clear the 9% and may accept then the project under those conditions. So the negative 14,835 would indicate that we didn't clear the rate, probably wouldn't accept the project. Now remember, you could then format your data here in a different fashion. So for example, you could go down below and say, for presentation purposes or even for working in your worksheet, you might just simply put the data that has information in it. So I put period 0 here, the 200, and then I'll start at period 5, meaning I eliminate these 4 items that have no information in them. And that would be the 40,000 through the 75. Then when I do the present value calculation here on period 5, I would then have to make sure that I pick up the proper 5 here instead of 0. I got to make sure that I'm picking up the proper time frame as we do the present value calculation. Obviously, then you could sum it up, get to the same number. Note, logistically, you could still, if you set it up this way, do your calculation present value for this first one. And as long as you're referring to this cell over here, instead of hard coding the number in the formula, you could then copy that down. And this cell, as long as you're making sure this isn't a 2 but a 5, should still do the calculation properly for you. So this is probably the shorter way to kind of present things and make it a little bit nicer. Obviously, if you're calculating this by hand using tables or something like that, it would be a tedious process, but possible, and you would want to limit the calculations as much as possible in that situation.